Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 7th October. Coming up on the show, the shutdown continues. There are growing reports of air travel delays. Meanwhile, the president looks for healthcare talks with Democrats. Tesla is widely expected to launch a new car today. Will it be enough to reverse falling sales? And I'll tell you why a Canadian mining company saw its shares pop almost 200% in the pre-market. So grab your coffee and let's own the morning. Well, the first thing you need to know is that the shutdown is rumbling on. It's already having an impact at airports where there are growing reports of delays. Why? Well, even though air traffic controllers are classified as essential workers and so should be paid in a shutdown, they aren't, and so there have been instances of staff calling in sick. Meanwhile, President Trump said he would negotiate with Democrats over healthcare subsidies. This appeared to represent a shift for the White House and Republican leaders who have insisted that Democrats need to vote to reopen the government before they will engage in negotiations over health insurance tax credits. Trump, hours later, though, said he'll be willing to talk only after the government reopened. The next thing you need to know about is that Tesla is widely expected to launch a new car later today. It's likely to be a more affordable version of its best-selling Model Y SUV. The EV maker is looking to reverse falling sales and dwindling market share amid increased competition. Over the weekend, Tesla posted clips on X which ignited excitement among Tesla fans. Major questions include the car's price, driving range, and efforts to strip down costs. Remember, prices effectively rose by $7,500 at the end of last month when EV tax credits ended. Now, Musk has been pivoting the firm towards AI, but affordable cars will also be key to Tesla, delivering 20 million vehicles over the next decade, one of the key milestones set by the company's board as part of its proposed $1 trillion pay package for Musk. And the last thing you need to know is that Wall Street looks set for a breather after another record-breaking day on Monday. Investors will be looking for more clues on the interest rate path today. We've got a big batch of Fed commentary today, including the central bank's newest addition, Fed Governor Stephen Miron. New York Fed President John Williams spoke on Friday. He said that the Fed must prepare for the unexpected and citing artificial intelligence and innovations in financial systems as a cause for unpredictability. Well, speaking of AI, the big driver in the markets on Monday was that multi-billion-dollar deal announced by OpenAI and AMD. Executive Editor Brian Sozzi spoke to AMD CEO Lisa Su.
We have the U.S. government now has a stake in Intel, which wasn't on my bingo card coming into this year. Some would say these tie-ups are causing risks to the AI industry or even the tech industry. What do you say to those critics?
You know, Brian, I would say that that's probably thinking too small. I mean, you have to really look at, what the power of this technology can do for the world. And if you think about all of the applications that can take advantage of AI and computing and, sort of the massive investments that will have, significant returns on the other end, it takes time to build all this out.
Well, joining me now is CFRA research analyst Angelo Zino. Angelo, thanks so much for joining us on Market Sunrise. Well, we've just heard from Lisa Su, AMD CEO. Is she right about the critics of AI?
Yeah, I mean, listen, thanks for having me. And when we start thinking about just AI in general and the broader theme, we remain very bullish on it. We think the trajectory here long term is one where we think investors are actually underestimating not only the long term, but also the near term impact that AI is having on a number of industries out there. And what we're actually seeing is actually adoption take place quicker than we anticipated across a host of different sectors and industries across the market. That's creating an immense amount of need for compute. I think even a company like OpenAI here recently stating that they can have 10x the amount of revenue if they had 10x the amount of compute out there. So we think the demand here is absolutely real, and we think we're going to see a supply constrained market here at least over the next 12 to 18 months, and investors should remain, we think, proactive in a number of these shares out there.
But who's this deal better for? We saw AMD shares rise over 20% yesterday, but is this deal better for AMD or for OpenAI?
Well, I think actually both sides get something out of this. Ultimately, I do think, AMD is better off from this deal in the sense that, hey, listen, it provides extremely good visibility for this company over the next couple of years. I think it also validates their AI ambitions in terms of their GPU server business. It's something that really hasn't gained momentum relative to what Nvidia has done here in recent memory. The fact that you now have that OpenAI win and potentially kind of see some significant momentum, we think is now going to crush some of the street expectations out there over the next 3 to 4 years. So yeah, we definitely like what it means for AMD. Most importantly, I think for AMD, they're really working on two things here in the sense of building that software ecosystem, something that Nvidia has a very strong competitive moat in, but their Rock M software now really kind of sees some significant momentum, we think, over the next couple of years, as well as their shift towards these large scale rack systems, which is going to start ramping in 2026. And that really, we think, from this OpenAI deal, confirms what AMD is trying to do right now.
Okay, we're going to try and pop up the AMD share price this year on the screen right now, but you've revised your price target as well. Where are you seeing AMD going?
So we upgraded the stock actually from a buy to a strong buy earlier this summer. Our 12-month target price, we also increased to $250 on this news. And again, it has a lot to do with the improved visibility we see and the validation from this OpenAI deal. But in the same respect, I mean, we do think there are so many other catalysts here tied to AMD, whether it be eventually getting back into the China market, we think is going to happen here over the next couple of months, or whether it be new sovereign AI deals, which also we think is going to gain momentum into 2026. So there's a lot we think that can continue to work here for AMD and its shares.
But where does this leave Nvidia? Only recently they had a big tie-up, $100 billion investment in OpenAI. Is it still the daddy, so to speak, of AI?
Yeah, listen, I think this is still Nvidia's world in many respects. When you look at AMD is still going to be a small player in this market, but a couple of $1 billion, right? Tens of billions of dollars for AMD here over the next couple of years is a huge deal for a company like that. But when you look at Nvidia, that competitive moat is really not going to change, we think, very much. They're going to continue to have at least 85 to 90% of the overall market. So they're going to dominate that market. And again, a number of catalysts that we think is going to continue to work for that company. But the bigger theme is, listen, we need a lot more compute in this market here over the next couple of years. What NVIDIA really specializes in is AI compute. So that is a theme that we don't think is going to change. And it is an absolute free cash flow monster. We think by the end of 2027, this is going to be a company that's going to be generating north of $200 billion in free cash flow on an annualized basis. So there's a lot that they can do with that money in terms of expanding their addressable market.
And just finally, we've seen lots and lots of deals, not just between US firms, but also between US firms and Japanese firms, and US firms and Alibaba as well in China. What do you make of all these deals that are being made? What does this tell us about the industry?
Yeah, I mean, listen, I think what this tells us is everybody needs AI. A lot of everyone across the globe is essentially working and kind of, having AI compute kind of at the localized level within their nations. And, this is where the sovereign AI deals really, make a big deal out there. But when you think about who has the IP on the compute side, it is the U.S., and that's really important. And our view is the expectation here in the U.S. is to continue to have that competitive advantage and really sell that leading edge technology across other areas of the globe, and to make sure we generate that revenue and we can kind of dominate. So I think right now the U.S. remains best positioned in terms of benefiting from the AI evolution here over the next couple of years. And I think you're going to see more and more deals and partnerships with other nations across the globe.
Angelo Zino from CFRA, many thanks for joining us.
All right, thanks for having me.
And the latest OpenAI deal, well, it was felt pretty strongly on the markets yesterday. And the $500 billion startup has the power to move shares, not just with the companies it makes deals with, but the wider industry. The company behind ChatGPT held its annual developers event yesterday. and mere mentions of other publicly traded firms by presenters sent those shares soaring. Most were named as partners whose apps are being incorporated into ChatGPT, the AI bot that counts some 800 million weekly users. Just take a look at this chart. But OpenAI isn't the only company to have this kind of impact. At Nvidia's GTC conference last year, CEO Jensen Huang's words saw big rises for engineering software firms like Synopsys and Cadence. Well, yesterday, OpenAI CEO Sam Altman was asked about his firm's influence on other stock moves and admitted that it's, quote, weird. Well, the hundreds of billions of dollars companies are investing in AI now account for a staggering 40% share of US GDP growth this year. And AI companies have accounted for 80% of the gains in US stocks so far in 2025. Okay, we're heading for a break, but coming up on Morning Brief Market Sunrise, we'll take a deeper dive into the healthcare sector. It's finally showing signs of life. We've got a closer look straight after this break. Well, it's been a rocky year for healthcare investors, but the sector is coming off a strong week and has some wondering whether it's poised for a comeback. Well, Jared Blickry takes a closer look at this edition of Stocks in Translation.
Need a break from the AI trade? Healthcare and biotech just had their best week in about 3 years, a sign of life in an area that many investors have left for dead. Is it time for a comeback? That's what we're talking about on today's Stocks in Translation. Now, of the 11 S&P 500 sectors, healthcare performance is dead last over the past 3 years. Here's a chart from Todd Sohn at Strategas ETF Research that shows just how unloved poor healthcare has been, and that's in green. And it's been that way since this bull market began 3 years ago. And it's especially so when you compare it to the tech sector in white. We're talking $10 billion in net ETF outflows for healthcare versus about $40 billion in inflows for tech. And after an initial pop in late 22, healthcare has been a story of steady selling. Investors have thrown in the towel, according to Sohn. But if price keeps picking up, those outflows can reverse and fuel a catch-up trade. Here's another way of looking at healthcare's shrinking relevance. In this chart going back to 2011, also from Strategas, we're taking a look at its weight in the S&P 500 versus that of industrials and also the world's largest stock, Nvidia. Healthcare at the top in green has trended down over the last 3 years, while Nvidia at the bottom in white has rocketed higher. And you can see industrials in blue has just moved sideways since about 2020. That a single stock is nearly as big as two entire sectors tells you just how crowded the AI trade is. So diversification isn't a bad idea. Let's take a look at some reasons to consider healthcare. First, it trades with low beta, which is a measure of market sensitivity and lower volatility. So more on this in a minute. We also just mentioned diversification, especially important when the AI trade cools or just takes a backseat, as it has done a few times already in this bull market. And according to Strategas, healthcare tends to do better than the S&P 500 itself in years of midterm elections in the US, and that's 2026. And some crucial context. Ownership is thin after years of outflows. Not many investors are on board with the trade, which can lead to a game of catch-up if price continues to pick up. And admittedly, that could be a big if. Here's a direct comparison between the largest healthcare ETF, XLV, and the biggest semiconductor ETF, SOXX, which is based on the Philly Chip Index, the so-called SOX. We just mentioned market sensitivity, or beta, which is much higher in the chips. It tends to go hand in hand with volatility, and these measures cut both ways. You don't tend to get as many gut-wrenching spills, but you also have less potential upside. And you tend to get bigger dividends with many healthcare stocks. Chips just don't return as much cash flow to the shareholders. But this can vary quite a bit when you drill down into healthcare's many industries. If you do want higher beta and higher volatility, take a look at biotech or genomics ETFs. They might not pay big dividends, but they will have more potential upside and, of course, downside as well. Big pharmaceutical giants, they tend to pay bigger dividends. Finally, when it comes to valuation, like the famous price to equity ratio, chip stocks have a much higher multiple, which can be a warning. But I'd also add that valuations can stay stretched or also very low for years, so this is not a timing tool. And here's your quick reality check. Rule 1, price must stair-step higher. Higher highs, higher lows, that is the definition of an uptrend. If price does the opposite and goes lower, those outflows will only get bigger. Then remember that rallies can be uneven. It can be very difficult to time a bottom in an unloved sector. And keep in mind that some industries within healthcare, they look much better than others. As an example, equipment does not have nearly a good setup as biotech right now, which leads to the final point. Always understand what you're investing in. Stock and ETF selection matter greatly. Bottom line, the setup for healthcare is here. It's hated, it's under-owned, finally moving. But the trade needs to earn investor trust to turn around. As Alpha Trend's Brian Shannon likes to say, only price pays. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast.
Coming up, we've got a look at some top trending tickers, including AppLovin and Trilogy Metals. The details behind the moves, straight ahead. Okay, time now for today's trending tickers. First up, shares of AppLovin extending a sell-off from Monday. The mobile advertising tech company reportedly facing an investigation from the Securities and Exchange Commission centered around data collection. According to Bloomberg, the agency is looking into whether AppLovin violated platform partners' service agreement in an effort to push more targeted advertising to consumers. The news sending shares down nearly 15% on Monday. Now, AppLovin declined to comment to Bloomberg. Check out this eye-popping move in shares of Trilogy Metals. Shares soaring roughly 150% as the US government announced it's taking a 10% stake in the miner. Keep in mind, this is a small cap stock. It has market value of less than $1 billion. And the company does not generate much revenue. The White House announced it has approved the Ambler Road project in Alaska, and the deal is part of the administration's effort to address critical mineral needs for the United States. We're also getting a look at consumer behavior with results from McCormick and Constellation Brands. McCormick just reporting earnings, third quarter results topping estimates on the top and bottom lines, but the company did cut its full year adjusted earnings guidance and said tariffs and higher commodity prices are weighing on its profits. As for Constellation Brands, the beverage giant rising ahead of the opening bell, the company's fiscal second quarter earnings came in above expectations, but the company still sees a challenging environment ahead. Constellation is facing headwinds from people cutting back on drinking alcohol, and the company noted earlier this year it's also seeing weaker spending from its Hispanic customers, which account for half of its consumer base for beer. The shares up almost 4% in pre-market. Now, quantum stocks are riding a wave higher in the last week. Key names in the space were all up double digits on a string of upbeat news. Well, Josh Lipton spoke to benchmark analyst David Williams on market domination and got a closer look at the bullishness on the sector.
We think that the U.S. has a very commanding lead today, but there's also the things that concern us are the ones that we don't know about, the ones that aren't as in the market or open about their capabilities. We do know they're making some really nice progress, and China is spending significant dollars in investment on the quantum computing space. But my suspicion is that the U.S. is still leading in that regard, and we need to make additional investment to ensure that we stay in the lead.
What about big tech's interest and excitement in this space as well, David? You think of Amazon or Nvidia. How, if at all, does that change? Does that affect the broader quantum computing landscape?
Yeah, it's really interesting because I think that there is an opportunity for, we talked about AI earlier, but have an opportunity for AI to really accelerate quantum and for quantum to accelerate AI. And so they're very complementary relationship there. And over time, I think we'll see more and more of that. And we're starting to see the realization, I think, even of big tech, that is capable and possible. And perhaps that we're closer to quantum advantage than many had previously anticipated. I know that Jensen Huang from Nvidia several months ago had talked about quantum being many, many years away, and he has since changed that tune a bit. But we know that we've got D-Wave and IonQ and Rigetti that are proving really close to being to quantum advantage, and we think the next couple of platforms will really prove that out.
You mentioned IonQ there, David. I know you tell your clients that's a buy. How come?
We like the really well-developed business model. They're participating across all things quantum, whether it's sensing, networking, or compute. We think their platform is making some really great strides, and the leadership team there has done a phenomenal job. They've also got the balance sheet to really support the continued R&D investment, and so they've got a really nice lead there, and we like that approach. We think there's also other opportunities in the space, and what we've been telling investors is that regardless of where you gain your exposure, these stocks really tend to trade in tandem with one another. So you need exposure. Picking the winner is not always the easiest case, but I think any exposure in the space will be a winning bet, at least for the near term.
You mentioned other names as well. What about Rigetti? Is that another name you'd be recommending?
Yeah, absolutely. I think Rigetti's got an incredibly strong patent portfolio. They've done some really great work on the superconducting side, which is really the most mature platform. We like where they're at. We think that they're making some really great progress on the fidelity side and across their entire platform. So yes, we do like Rigetti, and it's a name that we'd certainly want to own.
Now it's time for the call of the day, and it's all about gold. Goldman Sachs raising its 2026 year-end target on the yellow metal to $4,900. That's up from its earlier call of $4,300. The bank saying the recent rally is being driven by durable demand between central banks and Western investors. But one billionaire investor is sounding the alarm on gold's record-breaking rally. Citadel CEO Ken Griffin saying on Monday that flight to gold is concerning because investors are viewing gold as a safer asset than the US dollar. Now, while gold prices have surged nearly 50% this year, the US dollar index is down nearly 10%. Gold prices rising again this morning and will soon be testing the 4,000 level. Okay, that is almost all we've got time for. Let's have a quick look at where the US futures market will make Wall Street look like when it opens. And actually everything's kind of struggling for direction. It's maybe not a surprise after yesterday's sort of record rally led by AI and tech stocks after that AMD OpenAI deal. Okay, that is all we've got time for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.